Welcome in. Coming up on today's program, Secrets of Successful Wealth Building. You're watching What's Next with Money, a program with smart insights to guide your financial decisions. Let's get started. Wealth gaps. They come, they grow from time gaps. I'm going to show you today 3 time-saving money decisions you can make now, then how to set it and forget it with an occasional review, and the benefits of setting it and forgetting it, and the costs of not setting it. Plus, we're going to show you 3 enemies of wealth building, including time poverty. Time is the great accelerator or hindrance for good decisions and actions. Money is scarce, and so is time. Constant financial crisis and upheaval narrows time horizons. For some, thinking about a month in the future financially is challenging. This limited and narrow view of time robs our ability to use time and combine it with money in a way that creates wealth. And speaking of narrow, if you saw Top Gun, you see naval aviators pulling G's, increasing their weight, and as they do this, their vision narrows. They can't look forward in time. Their peripheral vision is gone. Their time horizon has shrunk. With that pressure, recently, I experienced 2 G's of Earth gravitation on a 0-G flight. So I was weightless for part of it, but as we ascended, I got 2 G's. Nothing like Top Gun, but I could pay for this expensive experience through wealth building and following many of the ideas I share on this What's Next with Money channel. And here, What's Next with Money, we care about growing ownership of assets for middle, moderate, and low-income Americans, and have and continue to produce programs covering closing wealth gaps, but we do it in context. It is this context we hope to bring you in each of our programs and playlists, a focus on what we can do now on personal finance with an eye toward future trends, history, and even consumer policy. And while we're at it, on this video for a bonus, I'm going to show you 6 secrets that support successful wealth building. We all make and prioritize time for our family, children, and work. For folks facing historic and chronic wealth gaps, though, time is tight. Just finding the space to think, learn, and focus can be distracting. Here, Americans might have 1 to 3 jobs, and it takes time to get to each of those, get set up for the next job, and return home, and possibly you're taking care of kids as well, and you've got childcare to deal with. Plus, just managing life, especially if you're on your own, or even if you have a spouse or partner to share the load, to talk and learn with about money. Yet time is essential to grow savings and investments and assets, in addition to reducing debt and building and learning and understanding about money. Now, where can we carve out a little time to set it and forget it? Well, a couple areas. Automatic enrollment in retirement plans and automatic savings programs. There's an old story of multimillionaire, today would be a billionaire, John D. Rockefeller. Now, John D. Rockefeller was seen one day on one of his strolls. Some young people were around him. He saw a dime on the ground. He stooped over with his crepit body to pick it up. And the young people said, "Mr. Rockefeller, you're worth millions and millions. Why are you bending over to pick up that 10 cents, that dime?" And Rockefeller said, "This is 10% on a dollar. So it's all relative." In essence, he was telling all of us it's never a bad time to save. So here are 3 time-saving money decisions you can make now. The first, retirement savings matches in your 401k at an employer, including folks' part-time work. More and more part-time gigs offer retirement savings. Defined contribution, but retirement savings nonetheless, and there's likely to be a match. So, but what happens if you leave that employer? And if it's part-time, that's likely to happen. What we don't want is something called leakage. We don't want lost accounts in retirement because every dime counts. We need to add that up and place that in a future context for our retirement. What we want is something called portability. Now, these are all the dimes in our past retirement accounts sitting around, but many Americans just leave these behind. They're worth hundreds and thousands of dollars, and if you project that into the future, some of those over time collected could be worth hundreds of thousands of dollars of lost retirement savings. And with that smart long-term time horizon, let's take a little time right now to grab that. So it takes a little time. You might be able to, if you leave that job, you might be able to keep that 401k where that part-time employment was, or even full-time employment. Some plans allow that, but it has to be a certain minimum. More likely, they're going to give you the option to roll it over to an IRA, a contributory IRA, or unless it's a Roth 401k, it would be a rollover to a Roth IRA. And you have a certain time frame. Otherwise, they're going to send you a check, and you're going to have to pay tax and a penalty on that. But you, with a rollover IRA, whether it's Roth or contributory, this is your collection basket. This is where you take all of that retirement, that 401k savings, and you pick it off the ground as you move from employer to employer. You collect it here, consolidate it, keep the costs low, know what you're doing. Get outside financial planning advice if you need it on that. Watch many of our videos for some of the principles that we show. So in that collection basket, it's not just the money you've contributed, it's the matches from your employer, that free money, that kind of automated free money that you receive by participating. So whether it's a small job or a large job, get that rollover IRA set up and collect what you earned and let it grow. Now, some employers don't offer anything, no 401k, 403b, etc. But many states are setting up something called an auto IRA program, sometimes known as a secure auto IRA savings account. This is another one of those set it and forget it. As you join one of those companies that doesn't have regular 401k, you would be automatically enrolled into the auto IRA program. There won't be a match, but it's your money that can grow and save in very low-cost retirement accounts. Now, most of these will be actually really good because they'll be the Roth option, which in theory could be a life preserver type emergency account. Now, I'm going to have a link in the comments section to show what states are offering these, and the list is growing. Now, let's look at 3 time-saving money decisions that you can make now. The earned income tax credit can help families of moderate income with kids save on their taxes and actually get a rebate, in essence, either year-round or one time in the spring. And you can plan for that annual tax refund event. And yes, I know you may have already allocated what your next year's tax refund may be, but look at it as a lump sum cash benefit, and it's worth planning for, to save, pay down debt, have some recreational or memory-making activity or celebration for your family. And of course, you can buy IRS-approved I-bonds, Treasury I-bonds that are inflation adjusted. These are savings bonds that you can buy up to $5,000 annually through your tax refund. You can also buy them directly through Treasury Direct, and we'll have a link to that. So we're talking about 3 time-saving money decisions you can make now. Here's the next one. Special employee benefits with real dollar value that you don't have to spend or match to meet your goals. Now check this out. At your employer, and this includes, again, some of the part-time employment settings, education, health insurance, health savings account, student loan reduction, special training or certifications. Many of these types of real dollar value employee benefits are yours for the taking. So they can provide improved job flexibility, add value to you as an employee and competitiveness in the marketplace, set you up for promotions, and equip you with skills that you can use with future employers, a small business you create, or even add value to your community through public service or volunteering. As another point of understanding to take a look at this, here's a top-down view of how accounts might work together and some elements that can be automated to save you time. So obviously, if you're getting a paycheck, some of that paycheck should be going to a 401k to grab that match. If you're in an employee setting where you're tied into the auto IRA, it will move that way for retirement savings. But you can also send a portion of your paycheck to not only your checking account, but maybe an emergency savings fund. You could have it move direct, like $10 to $20 a month go to that savings account automatically. And you can have other short-term goals articulated in your plan through automatic withdrawal that might go extra money that goes out of that paycheck, goes to a checking account or a savings account for debt reduction, down payment house account growth savings, vacation money, and to maybe other investments like a Roth IRA, 529 college savings. Both of those are fantastic to contribute to monthly because you grab that dollar cost averaging where as the market is down, more of your money buys additional shares. And it's a great way to ride out volatility and profit from it. You can also move it to other taxable brokerage accounts. Money could be saved for rental real estate. Now, one area we do not recommend automating, and that is credit card payments, because those hopefully should vary month to month. You don't want to set up an automatic payment that matches the minimum payment that the credit card company is saying you should do, because you want those paid off. You don't want that extra balance of consumer debt. So the whole idea is pay yourself first, eliminate that consumer debt, and have automated money moved to savings accounts, Roth IRAs, 529 plans, down payment, account growth, etc. Now, if you carve out a little time to set it and forget it on some of these, yes, you don't want to permanently forget it. You want to review it at least annually. Review these decisions because your life changes. One place that many of us have already set it and forgotten about it is subscriptions through streaming services and others, and those recurring expenses should be looked at periodically. And drop the ones you're not using and consolidate if needed. Tracking and lifting your credit score, managing your credit record can help you grow your net worth. We're not going to go into details on this video, but we have a link for a PDF, and we do this in most of our videos, the little booklet, How to Take Control of Your Finances, and it has links to government agencies and nonprofits to help you manage this important area of credit management. Now, don't forget to hit that subscribe and smash that like button. This helps move our content to more people who want to learn. Now, here are, as promised, the 3 enemies of wealth building. Time is tight, and just finding the space to think, learn, and focus can be distracting. Now, this is a brief poem by Benjamin Mays, former president of Morehouse College. It's historic. It's called, I Have Only Just a Minute. I have only just a minute, only 60 seconds in it. Forced upon me, can't refuse it. Didn't seek it, didn't choose it, but it's up to me to use it. I must suffer if I lose it, give account if I abuse it, just a tiny little minute, but eternity is in it. Enemies of wealth building with time deserts. This is a huge area. Many people feel trapped and squeezed with time, and there are many other factors that affect this in the area of geographic differences related to upward mobility. And here are 5 primary factors that contribute to that. segregation, income inequality, local school quality, social capital, and family structure. And these come from Harvard researcher Raj Chetty. Now, the enemies of wealth building also include income volatility. This adds frustration and time pressures to folks, a big contributor to the wealth gap. Predictable employment schedules, especially when juggling several jobs, is helpful. Daily pay, buy now, pay later. These are kind of two danger areas. Plus, payday loans, check cashing predators. And of course, it's always important, despite these new areas of personal finance that can kind of suck the life out of your cash flow, always trying to avoid evictions, prevent fraud, prevent ID theft. The big issue here, despite all those other challenging areas, is the matching of unpredictable income to regular expenses, and unpredictable schedules adds to this volatility and uncertainty. And for folks facing these areas, it's important, if you're eligible for government benefits, use all those that you can. Get outside advice. Families in these situations pool money to smooth their income to meet those regular expenses despite the uneven and uncertainty of the income flowing in. Now let's look at another area called time poverty. We know many Americans live in food deserts where moderate cost food and healthy varieties of food are not available. The same holds true with financial services deserts. Many of our friends and neighbors do not have local, convenient, time-saving access to mainstream banks, credit unions, financial counseling, credit counseling, home buyers counseling and education, much less financial planners, financial educators, bank-on programs, financial empowerment programs, and brokerage firms. Now, with time deserts, financial services deserts, and mobility deserts, folks may feel confined, but now there's a little hope on the horizon. There are apps, and the sharing economy can open up, through technology, new opportunities that few had before to break the geographic constraints of opportunity. Now, in the time desert area, there's much of this within our own control. Years ago, I met a professor in Florida named Bill Quain, who wrote a book about time poverty, and I've got it right here. And he notes with business, the lure of salary raises and kind of keeping on that fast track, including moving up to different employee benefits, sometimes we don't take the time to exercise our own control over money decisions that are more close to us. And this can contribute to our own wealth gaps. Indeed, time poverty can perpetuate our own wealth gaps without us knowing it's happening. Bill says too often we focus on moving up the ladder and work takes more time, and we lose that with our family, our side gigs, and our attention to wealth building outside our job. And there's more to money life than our job. And these include equity investments, potential rental real estate, like renting your first house, small business, perhaps additional training for the job or entrepreneurial enterprise you want to learn, grow into, and eventually own. Having a business of your own, Bill says, you utilize the time of others. He adds, you need to be driven by that dream, but a countervailing force could be an all-consuming professional job or multiple smaller jobs with more responsibility. This is really a time trade-off. You're trading off the quest for higher growth and advancement where you are and salary, but you end up with less time control in some of those money and ownership assets that you might need to put your mind to that you can control and actually can pay back more than the job. So the fast and the busyness track can increase stress and time poverty. And here are a couple of examples. Years ago at the Walt Disney Company, they used to have a saying for executives who worked for former CEO Michael Eisner. If you're not coming into the office on Saturday, they said, don't even think about coming in on Sunday. And indeed, that's what a lot of these executives and people moving up the ladder did. Now, I personally lived this notion as the head of a national organization for a while. During this time that I had this high-level job, I had the least focus on my personal finances and the least amount of time available. Sure, my salary, my benefits, and some opportunities went up, but my time narrowed. I was inattentive even to the allocation of my 401k account and the taxable accounts of stock investing and mutual fund, active mutual fund stock investor they had on the outside. Plus my newbie rental real estate business, so I was just renting out my first house. None of this was optimal. I knew I could do more in this area and I was being very neglectful. I had a wealth attention gap. Now, by changing jobs, I ended up dumping my time poverty outlook. And check this out. I doubled my net worth in 5 years. I sought the opinions and advice from 2 certified financial planner certificates. Even though I'm a CFP professional, the CFP professionals that helped me, that I used, address my investing biases and blind side. They gave me a new framework to see and manage asset allocation. And it's a framework I still use 20 years later. Oh, and by the way, how did I double my net worth so fast? Watch What's Next with Money. I share what works for me, as well as some of the best thinking from leaders in personal finance, investing, and financial planning right here on this channel. And wealth building is often a function of time, awareness, small actions, little actions, and actions, though, that are consistent. Our closing the wealth gap begins with a few small actions that capture some timely decisions that begin to grow wealth around us while we live life and focus on our dreams, career, family, and our personal human capital development. And that's our ability to earn income. With money, there is the time value of money. And it's a common definition that if I have money right now with me, that's more valuable than that in the future. And if it's off into the future, I need to be paid for that privilege while it's being kept somewhere. And that's really what investing is all about, the future date and those potential earnings. Now, this is a core principle of money. This is because money can grow only through investing. And an investment delayed or held up or being inattentive is an opportunity lost for gains in the future. Now, a person might ask, can wealth be built without respecting time? Well, not really. If you think that way, we're in a get-rich-quick system. And getting rich quick takes up time and mental capacity. It's going to take more time to manage a get-rich-quick scheme and try to participate into it and try to avoid loss, and losses are very high. And the chances of success are very slim. The chances of loss are significant, and all would lead to financial and personal discouragement. Instead, try a more slow and sure way that gives you financial energy, that your money is working for you, even though you only initially invest your time and perhaps automate part of that investing through payroll deductions, 401k matches, monthly index fund investing from your checking account to a Roth IRA. And always using dollar cost averaging that would help make volatility your friend because you buy more shares when prices are lower. Now, as promised, we're going to now look at some well-researched wealth building frameworks. And this is according to my friends at the Aspen Institute's Financial Security Program. And here we are in the home stretch. 6 conditions to support successful wealth building. Number 1, and this is known as a precondition for successful wealth building. And this is called financial stability. The notion of positive cash flow, not just living paycheck to paycheck. Eliminating harmful predatory debt practices. Having an ability to create a financial cushion, an emergency fund. Access to public and private benefits to avoid financial shocks. This is like financial shock prevention. And employee benefits in life insurance and disability, are often there, plus health insurance, paid leave. Number 2, investable money used for investments and asset purchases. This could be longer term savings for a down payment for a house or rental property, money to invest that you take out of your positive cash flow and earnings, or a second job or a side gig, to receive matches. Take the money with you. Consolidate retirement savings as you move from job to job, using rollover IRAs going back to portability. Picking up those dimes off the ground. Harvesting tax refunds, and even saving family financial gifts, investing those. Number 3, purchase affordable assets. This can include real estate, your first home, education, and some of these you can collect and get paid for free. Getting academic learning credits through employee benefits. The cost of college could be subsidized or even eliminated. Extra training. Some employers are now offering student loan debt repayment assistance as an employee benefit to be competitive in the marketplace. And of course, there are other financial assets outside of retirement, like saving and investing, kids' 529 accounts, owning stocks, mutual funds, I-bonds outside of retirement settings to build your net worth and financial flexibility and options. Number 4, consumer-friendly financial options including good credit and a good credit score, financial, debt, and housing counseling, as well as financial planning. Check out our What's Next with Money playlist. It's our cataloging of our programs as you need to seek financial answers and resources that are at low or no cost from public and nonprofit sources. Number 5, information and confidence. This can be gained through education and experience. I've learned from both to navigate wealth building decisions. Now, this takes time, but knowledge and experience can build on itself. It is a financial muscle that grows and gets stronger over time. You know, there's an old saying like, what are the 3 rules of financial planning? And here they are. 1, spend less than you make. Number 2, save and invest. Number 3, don't do anything stupid. Or Warren Buffett said, the 2 rules of investing. Rule 1, don't lose money. Rule 2, don't forget Rule 1. See yourself as an investor, as a wealth owner, a grower of wealth, an example of wealth building for you, your family, and community, and all the creative contributions to society that can flow from that. It could even feed a legacy with your family. Number 6, our last area, wealth protection. This is the ability to maintain wealth, protect it from loss, avoiding risky investments beyond your knowledge and risk tolerance, eliminating and avoiding frequent trading, which also creates tax problems and their own time deficits, fraud, debt, excessive borrowing, lending, unplanned gifting, or excessive family friend assistance. Sometimes that's not an option to not help, but excessive help may not be good for anyone, including you. You've just heard 6 examples of successful wealth building. They're well researched, they're interesting, but I realize many are aspirational for middle income families. But another factor is learning, role models, parents, grandparents, aunts, uncles, someone financially literate and active in wealth building who might take the time doing it with patience and few, if any, mistakes. Can you find role models like that in your family or in your neighborhood or at your workplace? Find role models and money mentors, but check their advice and their track record against other sources as well. Now, the wealth gap actually went down before and just after the pandemic, before we had this high inflation. Spending changed, debts dropped, savings increased, home values increased, wages rose, Stocks rose. Yes, there was government help during the pandemic, but now we have better consumer rules and protections from our prior bad mortgage problems and products. Most of those are fixed. Americans have shown they can advance wealth building and narrow wealth gaps in their family and their neighborhood. In addition to time robbing wealth, so does inflation, and we cover that as well in some of our other videos. And of course, we have several closing wealth gap videos in this series on retirement, housing, children, and more are planned. So be sure to hit that subscribe and the like button, and don't forget to share. Remember, new episodes of What's Next with Money are posted on Thursdays.